This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome to Chapter 1 of our series, Mastering the Stock Market, Frameworks and Strategies. In this episode titled Introduction to Market Frameworks, we'll explore what market frameworks are and why they're essential for navigating the complexities of investing. So, let's dive in. Global markets trade tens of trillions of dollars, yet most investors rely on gut feelings. A tweet moves a stock, a headline sparks panic, and portfolios swing wildly. How do a few stay calm and consistent in that chaos? Using rules that almost look boring, but quietly beat the crowd. Most people think the pros just know what to do. In reality, the best investors lean on something far less glamorous, structured ways of thinking called market frameworks. These are the quiet engines behind everything from Warren Buffett's patient stock picks to the massive factor funds run by firms like Vanguard and AQR. A solid framework lets you compare a hot tech IPO with a boring utility stock using the same logic, instead of chasing whatever's flashing on your screen that day. It forces you to ask, what am I actually paying for? Where is the risk hiding? What outcome am I really targeting? Over time, that structure matters more than any single tip or headline. In this episode, we'll unpack what these frameworks are, how they turn raw numbers into decisions, and why building your own simple version can shift you from reacting to the market to directing your capital with intent. Think of today's investors facing a fire hose of data: earnings calls, analyst notes, factor charts, macro forecasts, social feeds. Without structure, it all blurs into noise. A framework helps you decide what belongs on your screen and what you can safely ignore. For instance, some investors organize everything around a few testable beliefs. Cheap companies tend to outperform. Diversified portfolios cushion shocks, and certain characteristics like size, value, or momentum earn a long-run edge. Others focus on how different assets behave under inflation, recession, or rate changes. The key is deciding in advance which signals are allowed to move your money. There are 3 practical ways to see market frameworks in action: what you buy, how you combine it, and how you react when the world changes. Start with what you buy. One family of frameworks hunts for patterns in long-term data. That's where size, value, and momentum factors come in. Researchers like Fama and French sifted nearly a century of returns and found that on average, smaller companies, cheaper stocks by fundamentals, and those with strong recent trends have earned an extra 2 to 4% a year over the broad market. Quant funds turn that into systematic screens and algorithms. A more hands-on investor might just tilt a watch list toward those traits instead of chasing stories. Next is how you combine things. Bridgewater's all-weather approach is a clear example. Instead of guessing which asset will win, it asks how to spread risk so that growth, inflation, and interest rate shocks don't all slam the portfolio at once. They target around 10% volatility and risk-weight positions so that bonds, stocks, and other assets each matter, even if one slice looks tiny by dollars invested. That kind of construction mindset is a framework choice, not a prediction. Then there's how you compete with the market at all. Vanguard's first index fund was tiny, $11 million in 1976. But it was built on a simple belief. Most active managers won't consistently beat a cheap, diversified benchmark after fees. That framework led to products that now oversee more than $8 trillion. Here, the decision rule isn't find mispriced stocks. It's capture the market reliably and minimize drag. Notice how different these are. A factor investor might happily own a concentrated basket of high-conviction names. An indexer might own thousands of stocks and never read an earnings call transcript. Yet both are being consistent with their chosen logic instead of improvising. The danger isn't picking the wrong camp. It's thinking that any framework is a profit machine. Even all-weather lost money in 2008, just far less than the S&P 500. Index funds ride every bear market down. Factor premiums go through painful droughts. A sound framework narrows your decisions and makes them testable. It doesn't shield you from drawdowns or regret. That's why the best investors periodically revisit assumptions instead of endlessly swapping playbooks. They'll ask, is the factor premium still evident in fresh data? Are index fees still low enough to justify my approach? Is my risk mix still aligned with my life? They tweak the inputs, not the underlying discipline. Your challenge this week. Pick one investing decision you made in the past year, buying a stock, a fund, even choosing to hold cash, and reverse engineer the implicit framework behind it. Write down, what belief about markets was driving that choice? For example, growth always wins. The Fed controls everything. It's safer if it's popular. What evidence, if any, did you rely on? Was it long-term data, a friend's tip, a headline, a chart pattern? What risk were you assuming on purpose, and what risk was sneaking in that you didn't name at the time? Then, run a quick experiment. Redesign that same decision using one of the explicit frameworks from this episode. Option A, a simple factor lens. Ask, is this closer to a small, value, or momentum type exposure, or the opposite? How would sizing it differently change my overall tilt? Option B, a risk mix lens. If my entire portfolio behaved like this decision, how would it likely perform in a deep recession? In a spike of inflation? In a rate-cutting cycle? Option C, a market tracking lens. If instead I had chosen the broadest low-fee index available, what would I have gained in diversification and simplicity? And what active edge would I be giving up? You're not grading the old decision as good or bad. You're stress testing the thinking behind it and practicing the shift from one-off choices to a repeatable structure. Think of three friends all looking at the same stock chart. One sees breakout potential, another sees overpriced hype, the third shrugs and buys the whole index instead. They're not just disagreeing, they're quietly using different frameworks, even if none of them could put that into words. To make this concrete, look at how a disciplined dividend investor and a macro trader might approach the same utility company. The dividend investor might zoom in on payout history, balance sheet strength, and whether the yield fairly compensates for slower growth. The macro trader might barely glance at the yield, focusing instead on rate expectations, regulation risk, and how the stock behaves when bond yields spike. Both can be rational, but their playbooks highlight different levers. Your job is not to copy theirs, but to notice which levers you habitually reach for, and which ones you ignore until they hurt you. Over the next decade, your default framework may quietly shift from static to adaptive. Instead of setting a mix once a year, you could rely on software that learns your habits, cash flow needs, even how you react to losses, then adjusts exposures in the background. ESG and impact layers might feel less like virtue signals and more like toggles in a settings menu, changing which projects your capital helps fund while an engine still targets tax efficiency and sensible rebalancing. Over time, you'll notice something subtle. The more explicit you're thinking, the less each headline controls your mood. You're still exposed to surprises, but decisions start to feel more like running plays from a playbook than reacting to a buzzer. In later episodes, we'll layer in position sizing, timing, and taxes so your framework becomes a living system, not a static rule sheet. Try this experiment. Pick one product you use weekly, like Spotify, DoorDash, or Notion, and for the next 24 hours, deliberately act as if you are its worst fit customer instead of its ideal one. Use it in a way its core market segment wouldn't. For example, use DoorDash only for picking up free condiments, or Notion as a one-line sticky note app. And write down every moment where the product clearly isn't designed for you. Then flip it. Tomorrow, use the same product like its perfect fit target user, heavy usage, recommended flows, paid features, and list what suddenly becomes smooth, delightful, or over-optimized. Compare the two lists and circle 3 to 5 patterns. That contrast is your live, real-world market framework, showing you who this product is truly built for and how its positioning shapes the experience. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!